Investing in IPOs, initial public offerings, has become one of the most thrilling ways for Indian investors to enter the stock market. But while we often focus on listing gains or long-term growth, there's another important aspect we cannot ignore: taxation. Understanding how your gains from IPOs are taxed helps you not only boost your actual profits, but also stay compliant with Indian tax laws. In this video, we'll break down all the essential tax implications of IPO investments, clearly and simply. When you sell shares that you've bought, whether through IPO or later in the market, the profit you make is called a capital gain. These gains are categorized into two types: short-term capital gains, or STCG, and long-term capital gains, or LTCG. This depends entirely on how long you've held the shares. If you sell them within 12 months, it's short-term. If you hold them longer than 12 months, it becomes long-term. Short-term capital gains arise when you sell your IPO shares within 12 months of allotment. Until recently, the tax rate was 15%, but Budget 2024 increased it to 20%. This change was brought in to curb speculative trading. Remember, there is no exemption limit for short-term gains. Every rupee of profit is taxable at 20%. Now, if you hold your shares for more than 12 months, the profit qualifies as a long-term capital gain. Here's the good news. Up to rupees 1.25 lakhs of LTCG in a financial year is completely tax-free, as per the revised limit in Budget 2024. Any amount exceeding rupees 1.25 lakhs will be taxed at 12.5%, a favorable rate compared to STCG. Let's understand short-term capital gain tax with an example. Suppose you bought 50 IPO shares at rupees 500 each, and you sell them on listing day for rupees 700. That's rupees 200 profit per share. Multiply that by 50 shares and your total gain is rupees 10,000. At the 20% tax rate for STCG, you'll pay rupees 2,000 in tax. Now let's say you held those 50 shares for more than a year and then sold them at rupees 800 each. That's rupees 300 profit per share, or rupees 15,000 in gains. Since this is under the rupees 1.25 lakh long-term capital gain exemption limit, you'll pay zero tax. Long-term investing has its rewards. But what happens if your total long-term capital gains for the year go above the rupees 1.25 lakh exemption limit? Let's take an example. Imagine you made a long-term profit of rupees 2 lakhs this financial year by selling shares after holding them for over a year. Now, the first rupees 1.25 lakhs of this gain is completely tax-free. That's your exemption. The remaining rupees 75,000 is taxable. And since the tax rate on long-term capital gains is 12.5%, your tax comes out to rupees 9,375. So, even though your total profit was rupees 2 lakhs, you only pay tax on rupees 75,000 of it. And that too at a lower rate than short-term gains. This is why planning when to sell your shares after 1 year instead of right away can help you save a lot in taxes. Now let's understand how you can save tax using losses from shares. If you make a loss while selling shares, say you sold them for less than what you paid, it's called a capital loss. There are two types: short-term loss, when shares are sold within 1 year, and long-term loss, when shares are sold after 1 year. Now here's the good part. A short-term loss can be used to reduce your tax on both short-term and long-term profits. But a long-term loss can only reduce tax on long-term profits, not on short-term ones. And if you're not able to use the entire loss in the same year, that's okay. You can carry it forward and adjust it against future profits for up to 8 years. Just make sure to report it in your income tax return every year. Let's understand with an example how you can leverage capital losses to save on taxes. Suppose you have a long-term capital gain, LTCG, of rupees 2 lakhs in a financial year. As per the current tax laws, the first rupees 1,25,000 of LTCG is exempt from tax. This leaves rupees 75,000 as your taxable LTCG. Now imagine you also incurred a short-term capital loss, STCL, of rupees 50,000 during the same year. The tax regulations allow you to offset STCL against both short-term and long-term capital gains. By applying this, you can reduce your taxable LTCG from rupees 75,000 to rupees 25,000. Consequently, your tax liability decreases significantly. Instead of paying tax on rupees 75,000, you're now taxed only on rupees 25,000. This strategic use of capital losses can lead to substantial tax savings. Remember, if you can't utilize the entire capital loss in the same year, you can carry it forward for up to 8 years, provided you report it in your income tax return, ITR, each year. Filing taxes? Make sure your IPO-related capital gains are reported in the Schedule CG section of either ITR2 or ITR3, depending on your income. You'll need details like the buy price, sell price, and the ISIN. That's the International Securities Identification Number of the shares. Here are a few handy tips. First, plan your exit. Decide whether you want to take short-term gains or wait for long-term tax benefits. Maintain accurate records of all your IPO transactions. Use set-off provisions to your advantage. And if needed, don't hesitate to consult a tax advisor to ensure you're making the most tax-efficient decisions. In conclusion, understanding the taxation around IPO investments isn't just about compliance, it's about maximizing your net returns. With the recent changes in Budget 2024, like the new STCG and LTCG rates and updated exemption limits, staying informed is more important than ever. Use the rules smartly. Classify gains correctly, use exemptions, and offset losses. That's how you make your IPO journey more profitable. If you found the video informative, don't forget to like, share, and comment. To be IPO ready, check the link in the description. Happy IPO investing!